with regards to staying invested. I think that's very much true of the bond market right now as well. Probably even more so than the equity market from a certain standpoint. That standpoint being, I don't think people follow the bond market as closely as they do the stock market. Right. I think it's just natural.
And it's the quote unquote, the smart money, right?
Right. And so, when I tell you that we've seen almost a 4% uplift off an April bottom in the bond market, people are generally surprised.
Yeah.
Just like people are surprised to hear that we've had almost a 10% run in the bond market since October.
Right.
And so that's kind of a precursor to my whole point here. I still think your value proposition is incredible. You have higher starting yields. After the Fed stopped hiking rates, you have not had a bond market that's kept up from a return perspective like you've seen historically. And if you look out farther, regardless of if the Federal Reserve cuts this year or next year or how many times, that proposition is still there. And once expectations around the Federal Reserve do change, the bond market's going to move fast. And you've seen the bond market move fast at points this year already. We started the year with 6 to 7 expected rate cuts. Now we have 2 being priced in by the market. And that's even a change from 3 months ago. And you've seen how the bond market can change. And so what I'll show on the screen right now, I'm showing 2 separate dates that marked recent bottoms in the bond market. In blue, I'm showing the bottom that was experienced by the Bloomberg US Aggregate Bond Index on October 19th of 2023. And in green, I'm showing the bottom of the market that was experienced on April 25th of 2024. And then through the chart, you can see how many trading days has been since the bottom and the cumulative total return. And what you'll see is that, again, these moves can happen pretty quickly, pretty swiftly. You saw about a 6% return for the bond market in November. That's your entire year's worth and more of a money market fund return, right?
Yeah.
And so in brown, as the legend would suggest, I'm just showing you a money market fund that's going to yield 5.3% annually and how that stacks up relative to catching the bottom in the bond market. Now, just as we talked about previously, you're not going to catch the bottom perfectly. But even so, I could show this data and pick somewhere in the middle, catch some of the drawdown and all of the upswing, and your return proposition will still be better than sitting in cash, sitting in a money market fund.
Yep.
So what I would say is, yes, that once in a decade investment opportunity still exists because the ag is roughly flat this year. And I would much rather be early than late and get paid while we wait.
Well said.